RBA. What do they want to do? Why, if the economy's growing at 3.5 and your unemployment's not that high, why do you have rates at an all-time record low? It's all about trying to boost a few things. Number one is you give the consumer more money, hopefully they'll spend a bit more. Secondly, if you keep interest rates really low, house prices go up, which make them more wealthy or feel more wealthy, and they'll spend some more. You also would hope that you get a big increase in construction activity, and also if interest rates are really low, the business sector might start to borrow and invest. So that's the focus. So what I'm going to do now is talk a little bit about how they're going in each of those sectors. So consumers are still very conservative. This over here is basically the savings rate. It's no longer as high as what it was during the time of the Lehman Brothers shock, but it's still pretty high. So consumers, if we're sitting in the bank, for example, our credit cards are still negative compared to this time last year. So the size of our total credit card book is smaller than this time last year. So, and our personal loans are sort of doing the same thing. Home loans are slightly better because that's associated essentially with lower interest rates and increase in house prices. But you know, if you look at this, you'd say that's a conservative consumer. We go underneath, and when everyone says cost of living is causing you grief, that comes out all the time in our surveys. So we've actually asked a special question about what do you mean? What is causing you grief? And the things that cause you grief are, if you probably can't see this, utility prices, education costs, housing costs, financial commitments. In other words, these are things that consumers think they have to spend. You have to put a roof over your head. You have to get your kids educated. You have to pay for utility bills. And the reverse, up the other end, what they're not worried about is things like travel, entertainment, keeping up with the Joneses. So it's very much this discretion, I have to have it or I don't have to have it. In terms of where we expect the consumer to be, the red and yellow line there is some econometrics of fancy equations of where the consumer should be spending based on the past. And what the message here is, the consumer is not spending as much as you would normally expect them to spend. We think it's going to get better because we think interest rates eventually work, house prices eventually work, but they're still subpar. One other thing that I think is really important at present is a psychological thing. Consumers got really spooked by the budget, okay? So we have something called consumer anxiety, and we break it up into, are you worried about your job? Are you worried about your health? Are you worried about you don't have enough ability to retire? Are you worried about your cost of living? Are you worried about the government? And what you see in the last reading, which is the one between June and March this year, quite a spike. And then we go and ask them about what parts of the budget, why are you worried about this? Is it the budget? What are you worried about? They're worried about their financial position. Now, in the past, when we've talked about consumer anxiety, it's always been consumers being worried about their lifestyle, their relationship, or something's gone wrong. It's never been about finance. Now it's about finance. And so that worries me. Recently, in fact, yesterday, you had consumer sentiment come back a bit, but I get worried that if the consumer is sort of nervous, they might actually shove their money and leave it in their pocket for a while. And that could cause flow-on effects to business outcomes. So at this stage, I'm sort of quietly watching, slightly nervous. So I'll be interested to see what Bernie has to say about sales, etc. But we're slightly nervous about the consumer. Overall, though, it's picking up. House prices, I think everybody knows, are doing okay. Very strong in Sydney. Is it a bubble? My short answer is no. So one of the ways we look at the consumer in terms of the ability to finance is we look, I'll put it in a simple way. We think the Australian consumer loves housing. Whatever they can borrow, they do, and they flog it up against housing, right? The right-hand side is a graph that basically goes back to 1982 and says, right, well, if you could borrow a certain amount at that stage and put it up against housing, there's a relationship between ability to borrow and where the house prices are. And so if you basically then said house prices move up and down according to that ability to borrow, I would show you that the relationship would run across that line there at 0, okay? So when house prices go up a lot more than you can explain, you get issues like the early 90s. And to remind yourself, house prices actually went up 35 to 40% in 1 year in the early 90s, right? You also got problems about Perth in the lead into the global financial crisis. Where are we today? We're actually below where we were in 82. And one of the cheapest ones relative to the ability to borrow is Sydney. So what I'm saying is house prices are not a bubble, they're reflecting what normally happens. And in fact, you would expect them to go up a lot more if the consumer was geared up like they used to be. So you'd get wealth effects. To me, what seems to be happening is we're starting to get some sort of stabilisation at some of these rates. Melbourne, for example, sort of gone sideways a bit. And as we go forward, we have a relationship there between house prices and a fancy econometric model. I mean, NAB by itself has about 250 billion, so we spend a lot of money, a lot of time trying to figure out what's happening to house prices. The model basically has three things. Supply-demand. If you overbuild, no matter where you are, you'll have a problem. If you want an Australian equivalent of Spain, Gold Coast, a couple of years ago. Right? Australia overall, though, is underbuilt. The next thing that matters is interest rates, and the final thing that really matters is unemployment. Because if unemployment starts to go up, people get nervous. So our sort of models basically say house prices should have gone up, blue is our model, earlier than they actually did, and now we think they're basically going to flatten out somewhere around about 4 or 5%, and you've got different effects there from history, particularly in Sydney. But generally, sort of better performances in Sydney and to some extent Brisbane, which is catch-up. But then going forward, think of house prices around 5 or 6%. That's really where we're saying things are going to be. Okay, foreign demand. A lot of people talk about what's happening. If I turn over here and this is a sort of a boring chart, but it's important. For the last 30 years, 4 houses get built for every apartment that gets built, roughly. Last year, almost 1 for 1. So what's happened is essentially, and there's no real information about how much foreigners are actually buying. So what we try and do is we try and say, we go to the property developer and say, how many of your sales were to foreigners? And what they're sort of saying here in the yellow bars is somewhere around about 10 to 12% of every new apartment that gets sold in Australia is sold to a foreigner. And we have a lot of anecdotal evidence. For example, it's very common to find in the CBD that you'll find a foreign developer comes in, buys something, puts 100 apartments on it and markets it mainly in China. So that's fairly common. And generally what you see is some volatility, particularly a lot of volatility in the Gold Coast, but Melbourne is always fairly high and so is Sydney. So the focus of, and this means that there's going to be a lot more development in terms of apartments as they hit the market. So, you know, we have something like a forecast essentially that says investment in dwellings, i.e. construction of houses and apartments, is growing currently about 5% per quarter. And we think that's going to keep going for a while. Eventually, we think it's going to fade out a bit, but it does help fill in some of the hole. So this is not quite the way monetary policy is supposed to work. Melbourne, for example, is number 3 in the world for the number of cranes in the CBD. Number 1 in the world was Ottawa, but they've changed the rules in terms of how you can get a visa. Same story, mainly Asian money coming in, mainly, let's face it, Chinese money, looking for a bolt hole. Okay, so if I'm sort of giving out marks out of 10 for where the Reserve Bank is relative to what it was trying to do, you'd probably give them a 6 or 7 out of 10 for the consumer. They'll certainly get a 9 out of 10 for the property sector, but that's really not the way monetary policy works. That was more about Chinese money looking for a place. What about the non-mining investment? What's happening here?